All right.
Yeah, there, I can let people in now.
Okay,
Stop.
cool. Sounds good. Thank you. Yeah, so yeah, we had the group, we had Steve Sellingood's group, and a lot of people wanted to talk about specific CEFs. And so that's why we spun off a separate group called Open Discussion so that we could talk about specific tickers. Steve joined the group for a while and has since left to go do his own business thing. But that's kind of why we started the group back in 2020. At the time, there was about 500 different CEFs, and we all kind of had the same question. You know, we saw all these funds, and they were jumping all over the place, and we were trying to figure out how to analyze them and search out which ones were high quality. And so there was a lot of discussion early on about, oh, this is great fun, or this isn't a good fun. And it was kind of not a very organized conversation. So we temporarily spun off yet another sister group that just focused on quality. And about 20 or 30 of us got together and just kind of threw all of our lists together and found what was common to all of those. And so once again, that was a very subjective way of looking at it. And we, you know, that worked for a while, and we all had our opinions, very opinionated opinions about which funds were good, which weren't. So I was looking for more empirical data for doing back testing of all the funds. And so there was a website called Portfolio Visualizer, and I started doing a lot of back testing on basically all 500 funds, and I spent a lot of time doing that. That Portfolio Visualizer website was really useful when I was using it back years ago. It has since changed hands, and the functionality has changed, and I haven't done much in there recently, but that really, I spent a lot of time in there in the early, I'd say 2021, 2022, back testing funds. And I was interested in when, or looking for funds, and it didn't matter when you invest in them. I wanted to look at funds that you might buy just before a dip in the market, or maybe during a dip in the market, or after a dip in the market. So I looked at 4 adverse events that I considered important. You know, we had the 2008 Great Recession. We had an oil crash in 2015 and 2016. We had a flash crash over Christmas of 2018. And then obviously we had COVID in 2020. And those were all roughly V-shaped recoveries of pretty adverse events. And so I was looking for which funds did well through those. And I have a spreadsheet here. I'm not going to go into the detail of this because we could spend several hours just going through how we came up with a scoring mechanism. But basically, I ranked all 500 funds based on how they performed through those 4 adverse events of the Great Recession, the other 2 dips, and then COVID. And came up with a scoring method. I did the scoring, getting a lot of feedback from you guys, and came up with basically a ranked list of all 500 funds. And at the time, you know, PTY, which is it's a PIMCO bond fund that is, in my mind, really one of the best. It floated to the top. We had a few more bond funds that floated to the top. PDT was up there. This is a health fund. And then we started getting into some of the stock funds, and then a mix of other bond funds. But basically, I had developed a ranked list of all roughly this was 400 funds at the time, based on how they performed through a 5-year rolling investment horizon through a recession event. So I'm not going to go into any more detail on that, other than to say that was kind of historically how we started to measure quality, is how they perform through a recession. So I had narrowed the list down to about 300 funds, and I think in 2022 I had invested small amounts of money in about 200 different CEFs that the ones that were at the top of the list. I spent a lot of time tracking and analyzing those funds. And at the time, in 2022, I had the time. I had just recently retired and was really spending a lot of time looking at funds, talking on the phone with Steve Selingut and others, and getting into his profit-taking strategy, which, if you're familiar with him, he likes to basically invest in. He has an investment universe or a selection of funds that he's willing to invest in, and he basically sorts them by yield. And he buys into whatever's yielding the best, and when it increases by 5%, he sells the full position, and then he looks for the next available high yielding fund. And he may sell a fund on Monday and buy the entire position back on Friday. And that method didn't really sit well with me and others. I found that I kept buying BST, which is one of my favorite funds. It's BlackRock Science and Technology. I would buy it and turn around and sell it, and then buy it again a couple of days later and turn around and sell it. And I was like, there's just got to be a better way. And Scott's not on the call, but I think he was a trader formerly, a stock trader, and he kind of turned us on to this strategy of just skimming. You don't have to sell the entire position. You can invest a core position, say $10,000, into a fund, and if that fund goes up to $10,500, just sell off the top $500 worth. So you're skimming 5% off the top, and then if it dips 5%, you buy it back, and by doing that, you're skimming profits, you're buying more when it dips, and you're collecting on a core position throughout the entire process. And so I wanted to take a look at analyzing that, and we're going to take a deep dive into a spreadsheet looking at that method. And before I do that, just got to do my disclaimer here real quick. I'm not a professional investor. I'm semi-retired amateur. I'm not here to sell you anything. I'm simply offering this for peer review. I've done these in the past, and I get great comments back from you guys. It helps me improve what I'm doing. So this is we're just sharing information back and forth. I'm not here to provide you with investment advice. These returns are historical and or theoretical. Some of these are theoretical, but some of these are actual. And so I like getting negative feedback. I love when people say, well, you didn't think about this. And so it causes me to go back and rethink about things and hopefully fix things. So let's see, let me clear out one of those tabs. Okay, so I'm going to go through a conceptual spreadsheet of Scott's method of skimming profits on rallies, buying more on dips. And I've done this in a very simplistic view, and I want to walk you guys through this method using theoretical data, and then before we look at real data. So I've just kind of mocked up a theoretical ticker. I call it AAA. And let's say the price of that stock or CEF is $100. If I bought 100 shares, that would be a $10,000 investment. And let's say that it's yielding roughly 7%. It's going to give you 58 cents per share per month as a CEF. And so for the month of January, if you bought it on January 1st and you collected the dividend at the end of the month, you'd collect $58 on that initial investment of $10,000. Okay, so we're dealing with a 7% yielding CEF, and this is just showing monthly income. Okay, let's say in February the price went up to $103. You still have 100 shares. You haven't done any trading. Your market value of that position has increased to $10,300. At the end of the month, you get the dividend of 58 cents a share. You still have 100 shares, so you get $58. Okay, let's say in March, at the end of the month, you have 100 shares, and let's say the price went up to $105. So your market value of that position has increased from 10,000 up to 10,500. You had 100 shares, you're collecting that dividend of $58, but it's time to skim that profit. So you're going to sell 4.76 if this, and this assumes you can sell fractional shares. Again, this is just conceptual, but you would sell 4.76 shares, get your balance back down to $10,000, and you would profit $500. You'd take that $500 off the top, put it in your pocket. Okay? Then the next month, let's say the price goes down to 103. You still have 95.24 shares. Your market value has dipped down. You're still collecting 58 cents per share. So your dividend income, if you had placed that trade, is going to dip a little bit here down to $55 for the month. Then let's say at the end of May, you still have those 95.24 shares. Let's say the price dipped down to 99.75. So your market value for that entire position has dipped 5% below your $10,000 target. So you're going to buy $500 worth of that fund to get you back up to 10,000. So in effect, what you're doing is you're spending the same amount of money, but you're getting more for your money because the share price is lower. So you end up with 100.25 shares to get that market value of 10,000. So you started with $10,000 initial investment, you skimmed off $500 in profit, you reinvested it a couple months later, and what you end up with is more shares. So your dividend income, your monthly income has gone from 58 up to 58.15. Now this doesn't sound like much. And again, this is just conceptual. I'm trying to get your head wrapped around the concept of just selling for profits and buying it back later. Okay, so let's say nothing else happened throughout the rest of the year. The price didn't really fluctuate, and it ended the year at the same price that you bought it at the start of the year. So with that one or two transactions of selling the profit and buying it back, you end up with more shares. Okay, so your $100 price, what you started with, and more shares actually equals $10,025. So your market value on your position is actually going up by $25, and you're collecting more income. Now, had you done, or I guess throughout the entire year, you're always getting 58 cents per share. And based on the number of shares that you have, based on buying and selling, you're getting different amounts in your base income. So at the end of the year, that fund returned $6.96 a share. You had 100 shares, so your base income was $696. So this is the buy and hold strategy I'm looking at right here. Your base income was $696. Your investment amount was $10,000. Your residual after 1 year is still, if you did a buy and hold, you still only have the 100 shares at $100 per share. So your residual amount of that position is $10,000. So your net gain for that investment was $696, or roughly 6.96% for the year. Had you done this simple trading once, skim a profit and reinvest it a little bit later on, your base income would have gone down actually, because you collected less for a few months and you only collected a little more the remaining months. So your base income only equaled $691 instead of $696. However, your market value went to $10,025. So you're actually up $25, and here you're down about $5. So your net gain is actually $20 more in that investment. So rather than earning 6.96% for the year, you earn 7.16. And so this is the overall concept. And so I'm going to open it up to questions right now, because I want to make sure that everybody understands this. If you don't understand what I'm doing here, you're not going to understand it when we start looking at a true fund and all of its true price gyrations over an entire 10-year period. So if you guys want to chime in with questions, now's the time to do it. You would have to unmute your microphone.
Hi, Will. This is Leslie Sperling. I just have a question on this. I've looked at this method before that you've had, and how do you know you're not chasing a bad equity down? I'm thinking like CLO, this
Yeah.
ECC or something.
Yep. Yeah. So that is why I'm running all of these back tests analysis. So we're going to get into that. I wanted to get everyone's head wrapped around the concept, and then we're going to go look at all of the funds and see how they did over time. And I think you mentioned CLO, or maybe it was GLO. But we'll look at some winners, and we're definitely going to look at some losers here in a little bit. And a lot of times you can tell that by looking at the price chart on CEF Connect. If you see a long downward trend, you know that you're constantly adding more money to a fund that is going down in price. And so it becomes a balance of, is the income that's being generated as you're buying more shares, does that outweigh the loss in your position? A great example of this, and I don't invest in YMAX. I don't advocate investing in YMAX, but there's a member in the group that does this method with YMAX. And I think yield, it's called Yield Max. I think the yield on that is like 50% or some crazy number. But the downward price trajectory is it's just falling off a cliff. So he's comfortable with the fact that he's making more money because he's buying these shares. Eventually, he's going to have to look for an exit out of that position, which is why I don't invest in those kind of funds, because I don't really want to chase all that information and watch it closely. By using this method that I'm showing here on the screen, I can be an active trader like I have been this week, because it's been great taking profits, or I can go on vacation and ignore it for a month and come back and say, oh, these have really gone down quite a bit, I'm going to throw some money into them. Or, oh, these other ones, they've really gone up, I'm going to skim some profits. So for me, this method allows me to be active or passive based on how I'm feeling. So I don't know if I really answered your question, but maybe once we get into the other funds and show some of the losers, that will help. So any other questions about this spreadsheet and the methodology? Again, conceptually, does this all make sense that using a trading strategy is slightly better than a buy and hold? Okay. Well, I didn't hear anybody else chime in, so I'm going to jump into looking at FOF, which is a Cohen and Steers fund. Some of you may own FOF. It's kind of it's a fund of funds. That's what FOF stands for. It is a closed-end fund, and it only invests in closed-end funds. And so it's trying to crank out income for us by investing. I don't think it invests in itself, but it invests in all the other closed-end funds that are out there and spins off some nice yield for us. So it's a good kind of an all-weather fund. But if we look at that one, and again, I'm using what I did conceptually here, but I'm going to project it forward, and I'm going to show you. So I went into Yahoo Finance. I went into historical data and I said, give me all of the price changes for a 10-year period from January 1st of 2015, 2015 through 12/31/2024. So that's 10 years worth of data. And Google or Yahoo can give me back this data. It takes a little bit to load, but it's going to give me the date, the open price, the high, the low, the close on a daily basis. And so I can use this to basically simulate those 5% profits and 5% dips in this particular fund. And so I threw all that information into that same spreadsheet, the conceptual spreadsheet, and you can see it right here. So on January 2nd of 2015, if you had invested roughly $10,000 into FOF, you would have purchased 758 shares. And it's not an even 10,000 here because I'm using my own trading platform, which does not allow me to invest in fractional shares. I have to round everything off to whole shares. And so again, it's 758 shares, $10,005.60 would have been my initial investment. And let's just say that I bought in at the open of the day at $13.20. Okay, so from that, I can calculate what's my sell limit. 5% up from 13.20 is 13.86. That's when I can take a 5% profit. If I buy in at 13.20 and it goes to 13.86, my market value is going to go to 10,500. And so that's my sell limit. That's when I know that it's time to sell $500 worth of that fund. I can also calculate what's my buy limit. I bought at 13.2. If it dips down to 12.53, I'm going to buy $500 more of that fund. And so this spreadsheet, which you can see is quite long, and you would never want to do this with a calculator or paper and pencil. This is the value of doing this stuff in spreadsheets. And I'm just going to hide this so you don't see the punchline. So basically, I'm just going to walk you down slowly through this spreadsheet, and then eventually we're going to go really fast because it's just repetitive. You know, it gives you the date, the open price, the high, the low, the close, and then we're looking for these sell and buy limits, and that's going to trigger either selling or buying that fund. And by the way, back in January of 2015, that would have roughly yielded you 7.8% or 7.9% on that investment. So I'm going to scroll down, and you'll notice here the whole month of January we didn't earn a dividend, and this kind of jumped out at me. I was like, well, why didn't we get a dividend? But at the time, if you look back at the historical data, FOF only paid quarterly. So you would have to make this investment on January, and you wouldn't collect a dividend until you reached, let's see, down here, March 18th was the first time it paid out 26 cents a share. With your $10,000 investment, you would have collected $197.08. So that's what this spreadsheet is doing. Is I'm collecting all the dividends, and again, that's from this historical data. You can see, well, it's sorted. This is 2024. So currently the dividend is 0.087. But back in 2015, it was 26 cents a share for the quarter. So we're collecting the dividend. That's my base income. I'm scrolling down. I still have 758 shares because neither of my triggers have fired yet. I haven't gone up to 1386 and I haven't gone down to 1253. So I'm just going to scroll down through here and see when the price finally triggers. And here we go, June 18th. We can see our buy limit was 1253 and the low for the day was 1245. So that would have triggered adding $500 to this investment. And you can see the market value slowly trending downward. We're at 96. So on this day, it dipped down really low. and hit the $9,500 mark. So I bought the simulation here bought $500 worth of the fund. So my number of shares went from 758 to 798. I bought 40 more shares. I collected the dividend that date. And that's interesting also. This actually happens quite a bit. If you guys know what happens on ex-dividend date, right? The price drops based on the dividend. So that might be why this triggered a buy event. Is people saw that it was ex-dividend, they stopped buying it, and the price dipped, and so it triggered adding 40 more shares. So my total investment, remember the initial was 10,000. I've now added 5,000 to that, just like I did here. I added 500 right there. I'm sorry, I said 5,000, but I meant 500. So I added 40 shares at this price right here, 1253, for a total additional investment of $500. And so now I'm just going to go down through this spreadsheet, and also I'm putting a little ticker here for it's either a buy event or a sell event, and we'll show that later on how these compare when you get to the end of a 10-year cycle. So I'm going to scroll down through here. We see another buy event. Prices, let's see, it went from 1245, we're down to 1189, so we got to buy some more. We bought another $500 worth. Price is still going down. We bought 45 more shares for $500 additional investment. We're collecting dividends, and we're just scrolling down through here now. And so we're doing a lot of buying because the prices just keep slowly eroding downward. So there's a buy, there's a buy. Okay, so here the price, kind of hit the bottom of 998, and then it started going back up. And we had a nice upswing, about $500 worth. So I'm going to take that $500 profit, actually $507 profit, and put it in my pocket. Price went back down, so I had to buy it back. Then the price went back up, and that's a sell. So each of these green blocks with a number in it, that's a buy event, and the number of shares. And then the red is my sales. So I'm selling that, or taking that $500 profit by selling shares. And so again, I'm just scrolling down through the numbers here. So we're in 2016. We're buying, we're selling, we're buying. I'm sorry, we're buying, we're selling. We're going up. And so now I'm going to scroll faster. We're going down through 2017. It's just a lot of repetitive. And here I can see that the dividend has changed. We went from 26 cents for the quarter to 8.7 cents for the month. So in October is when they went from quarterly payouts to monthly. And so you're going to start seeing this dividend spin off. And so now I'm collecting $70 a month instead of 200 plus for the quarter. And that's the advantage of downloading the real data from Yahoo Finance. Is you can get the true dividend, including all of those wonderful specials that we get from some of the funds in December. All that special data is also in there. This is not just the monthly dividend. It's every actual dividend that was delivered to the owner. Scroll down through here, and you guys can just see it's buying, it's selling, it's buying, it's selling, it's paying dividends. And you can imagine what's going to happen in 2020 once we get there, because we're in 2019. We get to 2020, and what happened in March? We had COVID. So this is going to be where this exercise becomes very theoretical, right? Or very programmatic. this is not what you would really do, or this is not what I would really do. When COVID hit, I stopped buying. But when you're working through a model like this in spreadsheet, it doesn't have emotions, so it's going to buy. It doesn't matter how low the price goes. It's going to trigger a buy event for each of these days. We're buying, we're buying, we're buying, we're selling, and now we're getting into March, and we're buying pretty much every day. So this is where, again, this is where it's very theoretical. It's very programmatic. You wouldn't actually do this. I know that when COVID hit, I stopped buying. I think we all did. We were kind of, mentally and emotionally, we were drained with the stock market and watching our funds evaporate in front of us. And I think we were all probably kind of bottom fishing, looking for that bottom and looking for the point to get back into the market and start buying again. So this is a simulation. So this is what would have happened if you had simply set this to a computer program and let it buy and sell for you. It also assumes that you have, deep pockets of cash to buy $500 worth of this fund plus every other fund, every day for 10 or 12 days straight. Most of us don't have that kind of cash just sitting around. So probably would not have done this. But you can see at the low of the low price of this fund, the yield got up to 12.46%. And this is where Steve's method of analyzing things by looking at the yield, this is where he was probably looking at that going, yeah, it's time for me to buy FOF because I like that yield, 12%. So just going to keep scrolling down through here. The nice thing is we actually had more recovery than we did dip for this fund. And so if we keep scrolling down all the way to the bottom, and this is where you can see I've been tracking these buy events, and here's a sales. So I'm tracking all these. If we scroll down through the 10-year period, all of these buys and sells, had you done them programmatically like a robot, you would have had 66 buys and 68 sells. Okay, so you would have sold it 2 more times than you bought it. So that means your initial investment, and this is where I'm keeping tally of my investment, my initial $10,000 investment, now because I've sold it 2 more times at $500 profits, I really only have $9,000 invested in that fund at this point because I've taken those profits off the table, and I have 2 more events here. So let me show you these bottom columns, and we'll kind of keep these in mind. So the total amount of dividends shed by FOF over that 10-year period was $10.43 per share. And so if you were doing buy and hold, remember we started with 758 shares, so you would have earned 758 times $10.43. Had you used the buy and trade method, you would have ended that 10-year period not with 758 shares, but you would actually have 813 shares. Your market value is going to be 10,276. Your base income would have been 8653, and your residual, your investment, your de-risking of your investment went down by $1,000 to only $9,000. So let's scroll back to the top. I want to go through this summary with you guys just to kind of drill this point home. That using the buy and hold method, remember we bought 758 shares initially. We had our base income, which was the bottom of this column right here. If you multiply those 2 numbers together, you get $7,908.21 on that initial $10,000 investment. So that roughly translates to 7.5% over, that's every year for 10 years in a row. Had you deployed a trading strategy of skimming 5% profits and buying more with a 5% dip, your base income would have gone up to $8,600. Your risk would have gone down because you took more profit than you did buy. So your initial investment of $10,500, you've now only laid out $9,000 in FOF. You have a residual amount based on the price and the number of shares, which were greater at the end of that 10-year period. So we have 10,276. So long story short, your net gain is $9,900, which is about 2.5% better than the buy and hold strategy. And so this is where the beauty of spreadsheets comes into play. You know, you figure this out once, you figure out how to build this model for one fund, and then all of a sudden you can just start plugging in the data for every other fund that you want to look at. Or you could do a stock. It doesn't have to be a fund. And I've done a few stocks just to look at how some of those perform, and we can take a quick look at those. But basically, so this is FOF for the time period, for the 10-year time period of January 1st, 2015 through December 31st of 2024. And again, it's about 2.5% better using a trading strategy over buy and hold. JCE, which is another nice fund, it actually did quite a bit better. Again, I'm plugging in the same methodology. If you did a buy and hold, you would have earned roughly 8.25% per year for 10 years. Had you done a trading strategy, you'd get 4% more. It's like 50% better just by doing those trading. And we'll take a look at a summary sheet of all my funds, and we'll see which ones are showing a much greater return using the trading strategy versus the ones that it doesn't really matter. You can either buy them and hold them, or you can trade them, whatever you feel like doing. The last one I'm going to show here in the demo is BKT. Let's take a quick look at BlackRock income. You know, if we look at it on CEF Connect, you know, you look at this fund and you say, this is pretty, you know, it's BlackRock. They're a good company. It's a $400 million fund. It's yielding 9.8%. It's a managed distribution. It pays out monthly. That all sounds pretty good to me. If we look at the distribution history on it, you know, it's pretty flat. It's not going down. It's not going up. It's just kind of roughly remaining flat. And it's a pretty old fund. This goes back to 1996. So when I look at this in CEF Connect, you know, it's AAA, it's AA bonds. This is on the surface, this looks like a good fund to me, if I were to just look at it this way. The problem with CEF Connect sometimes is it doesn't give you all the data. So if you click on since inception here, you know, you see a slight downward trend here. And this, I think the question earlier about some of the funds that go down, this is an example of that. You know, it's gone from $13 down to, and this is the NAV, $13 down to roughly 11. The price is slightly under that. But wait a minute, I clicked on since inception and it only gave me 4 years worth of data. So sometimes you need to look elsewhere to find the real story on a fund, because this doesn't look too bad right here. But if we pull that up in Seeking Alpha and we look at the 10-year period, we see that BlackRock income really suffered. And this is the kind of the post-COVID years. They really suffered right there, and it never recovered. And so that's going to show up in our study, the buy and sell study. So if we go to the punchline here, we go to BKT. I won't go through the entire spreadsheet. I'll just kind of show you the summary out here. BKT, which currently is yielding, over 9%. Had you bought it in January of 2015, you would have earned a whopping 1.7% per year for 10 years. Had you traded it, you would have gotten 2%. These are not really numbers that interest me. These are not fun. This is not a fund that I really want to invest in when I look at it over the long haul when compared to other funds. And so this is why I like to look at, I don't think I have any funds that are less than 10 years old. I always want to look at least 10 years worth of data. And so again, BKT, it took some losses here and they never recovered. And that's going to show up in this is basically total return here is 2% per year. So that's the kind of the story of three funds, FOF, JCE, and BKT. Two of these are two that I do invest in. BKT, it's safe. It's AAA, it's AA, it's mortgage funds. But it just doesn't have a very exciting return for me. 2%, like it's not good enough. So, if we look at, I'm going to click on this spreadsheet. So I've gone through dozens, hundreds of different funds and grab the summary numbers for each of these funds. So CSQ as a buy and hold, 15% per year for 10 years. And I'm always looking at the same 10-year period, January 1st through 2015 through December 31st of 2024, because I want to compare apples to apples. How did these funds compare to each other through that same time period and those same adverse events of the oil crash, the flash crash of Christmas of 2018, and COVID. So CSQ, when I look at this, it doesn't really matter if you buy and hold or trade it. You're going to get roughly the same. And then, so I've got a different tab for every one of these spreadsheets. I'm going to jump to kind of again, the punchline here. These, I've grabbed the numbers for all of my favorite funds. So here again, BlackRock Science and Technology is yielding that's 21% right there. So $21,000 was your net gain on a $10,000 investment over that 10-year period if you did a buy and hold. Had you deployed a trading strategy, you would have only earned 16% per year. So this is an example of a very good fund that's better to buy and hold and not trade it. Either one of these returns, it's double-digit return. Either one of these is good. But for this particular fund, it's better to buy and hold. CSQ, that's the Calamos fund. It doesn't matter, 15%, whether you buy and hold or trade. EOS is slightly better using the buy and hold over trading. BTO is $15,000 or 15% per year versus 13% for buy and hold. So again, I've done a lot of funds, and these are the funds that are currently in my trading universe. These are ones that these are funds that I consider good, that I want to invest in, and then this chart tells me, should I buy and hold or trade it? And so if we looked at JCE earlier. Here's that 8% for buy and hold, 12% for trading. And so I've organized these. What I've done here to score them is I sorted descending on the buy and hold column, and I gave those a score in this column. And then I've resorted the fund based on trading and given it a score there. And then I take those two scores, I add them together, and that gives me a composite score for the two methods, whether it's buy and hold or trade. And then I can sort that ascending to give me, that's how I have basically decided that this is the best fund, because it was best at buy and hold, it was best at trading. And so you can look down through here, ACV, it did better as a trader than it did as a buy and hold. And you can see those results right here. If you buy and hold ACV, you can expect 10%. If you trade it, you can expect 13, almost 14%. And so the reason I've sorted these descending is I want to put my best yielding, or in this case, actually, my best total return. I want to put those in my Roth because that's tax-free. And the ones that fall further down in my list, I want to put in my IRA because I don't expect them to do as well, but I still want to invest in them. These are still cranking out 6 to 9%, but they're not doing as good as some of the others. So I'm going to put those in my IRA so that in the future I don't have to pay as much tax on those when I withdraw from that IRA. So for me, I want to put my best total return funds in my Roth so that all of that good total return is tax-free forever. Let's see. Let's take a quick look at a couple funds that I have real. So we were looking at theoretical data earlier, and Scott Phillips, in the past couple of weeks, he posted in the Facebook group about CGO, and he was talking about, or he was showing all of his dividends and all of his trades for that fund. So I decided to do the same thing for a couple of my funds. So CHY and CHW are a couple of my favorite traders. They're also a couple of my favorite funds. So CHY, I actually have $40,000 invested in CHY. These are the dividends that these are real distributions. This is data straight out of my brokerage. These are real distributions that I've taken from CHY over the past 12 months. And so here you can see on a $40,000 investment, it has returned $4,152.60. That's over 10% return. And I've also been actively buying and selling that fund. And here you can see each of the trades. All of my purchases are shown in red. And if you recall Scott's post, his were all right around $500. He's a very disciplined investor. He waits for that 5% exactly or close to it. Me, I get a little starry-eyed when I start seeing profits, and I tend to take them when I see them. So you'll see that my purchases don't equal 500. My sells, this one actually was 2,500, which is what it. No, that's not right. It should be. It was $2,500 is what I added to that fund. Oh no, sorry, that's a profit. So I sold it and I took a $2,500 profit. I took a couple months later. So this is in February. I took another $1,800 profit. Then I had to start buying it again. Here I took a profit. Here's a purchase. These are all profits. Couple more purchases. Whoops, don't do that. These are all profits. I had to buy it again a couple times, and then these are profits. And so the summary of all of that is on my $40,000 investment, I got $4,000 in dividends, which is roughly 10.4%. My profit taking far outweighed my additional investment in that fund. So I was able to skim off an additional 21% from that fund. So over the past year, my total return on CHY was 31.5%, which I'm pretty happy about. CHW, similar story. I only have $10,000 in that fund, so it returned 7.8%. But my profits that I skimmed off the top, 2,900, almost $3,000. So my total return was 36.9% for that fund.
Hey, Will, George has a question, I think.
Okay.